In 2019, one company was valued at $47 billion. It had no algorithm, no proprietary technology, no defensible platform. It owned desks and chairs and really nice coffee machines. And somehow, some of the smartest investors in the world looked at that and saw the future. This is the story of WeWork. But I want to be very clear with you from the start. This is not just a story about a CEO who spent company money on a private jet. It's not just about lavish parties or a flawed IPO or bad press. Those are the headlines. The real story is about something far more interesting. It's about what happens when you take a fundamentally physical business, dress it in the language of Silicon Valley, and ask the capital markets to value it like software. And that difference between narrative and reality, between what a company says it is and what it actually is what turned one of the fastest growing companies on earth into one of the most expensive illusions in the history of modern business. Before we go any further, if you are new here, welcome to Strategy Lens. This is a channel about one thing: understanding how businesses actually work. Not the press releases, not the TED Talks, not the founder mythology. The actual systems, the actual strategies, the actual decisions, and what they reveal about the way modern business really operates. Every week we take a company, a collapse, a pivot, or a playbook, and we pull it apart, layer by layer, until the real story becomes clear. WeWork is a perfect place to start, because almost everything you've heard about it is only half the story. And if this kind of deep dive breakdown is what you're looking for, hit subscribe, turn on notifications, because the next one is already in the works. And trust me, you don't want to miss it. Now, let's get into it. To understand why WeWork worked at first, you have to understand the world it was born into. The year was 2010. The economy had just been shattered by the financial crisis. Companies were terrified of long-term commitments. Startups were exploding out of garages and spare bedrooms. And the traditional office? It was a relic. You wanted space. You signed a 10-year lease. You put down a massive deposit. You hired a lawyer. You furnished the whole thing yourself. For a startup with 15 people and a credit card, that was impossible. WeWork looked at that friction and built something elegant. Walk in on Monday, you have a desk, a meeting room, fast Wi-Fi, a kitchen stocked with fruit and cold brew coffee. Pay month to month, leave when you want. No lawyers, no long leases, no stress, that's it. And for thousands of founders, freelancers, and small teams, it was exactly what they needed. The product worked, the community worked. WeWork, at its core, was a genuinely good idea. So what went wrong? Everything after that. Somewhere between 2012 and 2016, WeWork stopped presenting itself as a real estate company and started presenting itself as a technology company. Now, why does that matter? Because in Silicon Valley, those two words unlock completely different valuations. A real estate company gets valued at a multiple of its earnings. Conservative, grounded, asset-based. A technology company, it gets valued on potential, on growth rate, on the story of what it could become. WeWork chose the second path, and investors followed. The pitch was seductive. Uber didn't own cars, it owned the platform. Airbnb didn't own hotels, it owned the marketplace. WeWork didn't own buildings, it owned the experience, the community, the network. We are a technology company, they said, a platform, a movement. They even invented a word for it, space as a service. And if you were an investor sitting in 2016, watching Uber and Airbnb rewrite industries without owning a single asset, this sounded reasonable. This sounded like the future. The problem was that it wasn't true. To understand why WeWork's pitch collapsed, you need to understand one fundamental idea. The thing that makes a technology company valuable is not what it sells, it's how it scales. Think about Netflix for a second. In 2010, Netflix had about 20 million subscribers. By 2023, it had over 230 million. That's 11 times more customers. How many more servers did they need? More, yes, but not 11 times more. The marginal cost of adding subscriber number 231 million, basically nothing. That's the magic of software. Build the system once, serve 1 million people, then serve 10 million. The cost barely changes. The revenue multiplies. That gap between cost and revenue widening as you grow. is what creates the extraordinary valuations of technology companies. Or look at Amazon Web Services. AWS built cloud computing infrastructure, servers, storage, processing power, and then rented access to it. Thousands of companies, millions of applications, all running on the same underlying system. Amazon didn't build a new data center for every customer. They built one platform that could serve everyone. That is what technology leverage looks like. And that is the standard WeWork was holding itself to. Now here's where it gets interesting. Let's trace what actually happened every time WeWork opened a new location. First, they had to find a building, then negotiate a lease, usually 10 to 15 years. That's a fixed liability, locked in, unavoidable. Then, construction, custom fit-outs, each space uniquely designed, weeks, months, millions of dollars. Then, staff, community managers, cleaners, maintenance, local vendors, local suppliers. Then, marketing, filling the space, acquiring members. And then, maybe revenue. After all of that, every single time, with every new city, every new building, every new floor. This is not software. This is infrastructure-heavy, labor-intensive, capital-consuming real estate operations. And unlike Netflix adding a subscriber, every WeWork expansion made the business heavier. By 2019, the year of the IPO attempt, WeWork had signed leases worth approximately $47 billion in fixed obligations. And their revenue that year? About $3.5 billion. They were spending $2 for every $1 they earned. These aren't technology margins. These are the financials of a company, running as fast as it can just to stay ahead of its own debts. Now let's go deeper, because WeWork didn't just expand randomly. They had specific, deliberate strategies that made them look unstoppable on the outside, while the pressure was building underneath. The first strategy was community. WeWork didn't sell office space. They sold belonging. Every location was designed to feel alive. Open kitchens, rooftop terraces, beer taps, networking events, workshops, panels, startup meetups. The message was simple. When you join WeWork, you're not renting a desk, you're joining a movement. And it worked brilliantly at first. By 2019, WeWork was reporting that 54% of its members globally said the company had accelerated their business growth. That's not a real estate company, that's a community company. And community is sticky. Community is hard to replicate. Community, for a while, justified a premium. But community alone doesn't open 700 locations in 5 years. For that, you need capital. Enormous, almost incomprehensible amounts of capital. And WeWork found exactly that in SoftBank. In 2017, Masayoshi Son, the head of SoftBank's Vision Fund, met Adam Neumann for a 12-minute tour of a WeWork location. 12 minutes. By the end of it, SoftBank had committed $4.4 billion. Let that sink in. By 2019, SoftBank had poured over $18.5 billion into WeWork. And with that money came something more dangerous than debt. It came permission. Permission to grow at any cost. Permission to sign leases without asking whether they made sense. Permission to move faster than any business model could possibly support. It was a machine that fed on itself. Meanwhile, behind the scenes, WeWork was quietly making a smart pivot. They started targeting large corporations. Not freelancers, not startups, Microsoft, IBM, Amazon, Facebook. Companies with thousands of employees who needed flexible satellite offices without the burden of signing long leases themselves. By 2019, enterprise clients, companies with over 1,000 employees, made up nearly 30% of WeWork's membership. And these clients were different. They signed 2 to 3 year commitments. They were far more stable than month-to-month members. They paid more. And they added a veneer of legitimacy that helped WeWork sell the story of inevitability. Even the Fortune 500 is choosing us. This was a genuine strength, one of the few real ones WeWork had. And then there was Powered by We. This was WeWork's most ambitious strategic bet. The idea was this: large companies had their own office buildings, but managing those buildings was expensive, inefficient, unglamorous work. Procurement, facilities management, interior design, community programming. WeWork said, "Let us do it for you. We'll redesign your office. We'll manage the operations. We'll bring the culture, the community, the energy. You keep the building. We run the experience. This was white labeling WeWork's operational model into other companies' physical spaces. It was genuinely interesting. It had real margins. It had real scalability potential. But it was underfunded, underbuilt, and overshadowed by the relentless pressure to open new locations faster and faster. It never got the investment it deserved. Flush with capital and ambition, WeWork started buying things, lots of things. In 2015, they acquired Case, an architectural modeling and building information company. In 2016, they bought Welkio, a digital guest sign-in system. In 2017, they acquired FieldLens, a construction project management platform, and SpaceMob, a co-working startup in Southeast Asia, to accelerate their Asian expansion. In 2018, they bought Euclid, a spatial analytics company. They acquired Meetup, the community events platform, managed by Q-Team. And then, perhaps most extraordinarily, Rebecca Neumann, Adam's wife, launched WeGrow, a private elementary school, a school inside a co-working company. The vision, according to Adam Neumann, was to build an entire ecosystem, not just where you worked, where you lived, where your children learned. The full WeWork universe. We work, we live, we grow, elevating the world's consciousness, as he put it to investors. But what it actually looked like from the outside was a company spending money on everything except the core business that justified its valuation. Every acquisition added complexity, every new venture added cost, and none of them, not one, made the underlying financial model any more sustainable. But here's the detail that really exposes the fragility. WeWork's liabilities were long-term, their revenue was short-term. They signed 15-year leases, their members paid month to month. Think about what that means. In good times, when companies are growing, optimism is high and everyone wants a hot desk in a cool office. This looks like momentum. But the moment the economy slows, the moment uncertainty creeps in, members can leave in 30 days. The leases cannot. That's not a technology platform. That's a bet. A very, very large bet that the good times would never stop. Now, here's what's genuinely interesting about WeWork. The vision they described could have been built. Imagine, for a moment, that WeWork had actually built the technology they claim to have. A real-time global platform where office space behaved like cloud computing, where occupancy data from every building fed into a central intelligence system, where pricing adjusted dynamically based on demand, time of day, location, seasonality, where a company in Austin could spin up workspace in Singapore with a single click, the same way you spin up a server on AWS, where space utilization was optimized across the entire portfolio so no desk sat empty and no member went underserved. That would be a technology company. That would be defensible, scalable, compounding. The more buildings you added to that system, the smarter and more efficient the system would become. That's real network effect. But WeWork never built that system. There was an app. A nice app. You could book a room, check in, see your community events. That's not a platform. That's a feature. The difference between a feature and a platform is the difference between a lock on a door and the system that controls access to every door in every building in every city on Earth. One is a tool, the other is infrastructure. WeWork built the lock, called it infrastructure, and asked investors to pay infrastructure prices. This is the section most people skip, but it's the most important one, because the tragedy of WeWork is not that the vision was wrong, it's that the vision was achievable. So let's do something different. Let's build the actual technology roadmap that WeWork should have built, if they were ever serious about being a technology company. Step 1. Data infrastructure. Physical presence at massive scale. That is an unprecedented data collection opportunity. Every building, every desk, every room connected to a centralized platform. Build that layer first, then everything else becomes possible. Step 2. Dynamic pricing. Once you have the data, you build the intelligence. A desk in Manhattan on a Tuesday morning is worth 3 times what it's worth on a Friday afternoon. Airlines figured this out decades ago. Dynamic pricing would have unlocked enormous revenue without opening a single additional location. Step 3. The marketplace. Imagine WeWork as a two-sided marketplace, like Airbnb for offices, but powered by real-time availability data that only WeWork has. Now you're not just managing your own buildings, you're managing the entire flexible workspace market. That is a platform. Step 4. The enterprise operating system. Give those clients a dashboard, a full enterprise workspace management system. How many desks are occupied across all your global offices? A corporate real estate analytics platform would have been extraordinarily valuable to every Fortune 500 company on Earth. SAP, Salesforce, Oracle, WeWork had a dataset those companies could never replicate. They never built any of it. They bought a school instead. Behind the exposed brick and the cold brew taps, WeWork was one of the most operationally complex businesses you could try to run at scale. Each building had its own occupancy dynamics, its own local cost structure, its own quirks, its own market, its own competitive pressure. And because WeWork had no centralized intelligence layer, no system that could look across all of these buildings simultaneously and optimize them together, every new location was essentially a new company. You didn't get smarter as you grew, you got busier. The complexity compounded, the management burden grew, the organizational chaos deepened, and in 2019, WeWork had over 700 locations across 38 countries. There was no system built that could hold all of that together. In August 2019, WeWork filed its IPO prospectus, the S-1. Hundreds of pages of financial disclosure, public, unavoidable, legally binding. And what investors found inside was not a technology company. It was a real estate company with negative gross margins in some segments, an eccentric governance structure that gave the founder near-total voting control, and a valuation that made absolutely no sense by any conventional metric. The document revealed WeWork's net loss in 2018 was $1.9 billion on $1.8 billion in revenue. They lost more than they made, and they wanted to be valued at $47 billion. The public markets, unlike private investors, did not have the luxury of betting on a story. They needed numbers, they needed systems, they needed evidence, and the numbers told a very different story than the one WeWork had been selling. The IPO was withdrawn. Within weeks, the valuation was slashed. From $47 billion to under $8 billion, then lower. Adam Neumann, the founder, the visionary, was removed as CEO. The man who had convinced SoftBank to write a $10 billion check was out. WeWork laid off thousands of employees, closed hundreds of locations, and quietly became what it always was, a real estate company. A pretty good one, actually, but not a $47 billion one. Then came the pandemic. COVID-19 was an instant crisis. Members left by the thousands. Revenue collapsed. The leases remained. By November 2023, WeWork filed for bankruptcy, listing liabilities somewhere between $10 billion and $50 billion. The company that had been valued at $47 billion 4 years earlier couldn't pay its debts. Here's where the story takes its most ironic turn, and this part almost nobody talks about. When WeWork emerged from bankruptcy in June 2024, it had a new majority owner. Not a real estate company, not a private equity firm, a technology company. Yardi Systems, one of the most powerful property management software firms in the world, acquired 60% of WeWork for approximately $337 million. Think about that for a second. The company that spent a decade claiming to be a technology company sold itself, in bankruptcy, to an actual technology company for a fraction of its former value. The irony is almost too clean. So what does WeWork actually look like today? Smaller, leaner, more honest. The portfolio has shrunk from over 800 locations at peak to approximately 600 locations across 36 countries. During the bankruptcy restructuring, WeWork exited or renegotiated hundreds of leases, doing in one painful legal process what it should have done voluntarily years earlier. The result? Over $4 billion in debt eliminated. The balance sheet cleared, the business regrounded. By early 2025, WeWork had achieved 6 consecutive months of positive EBITDA. For the first time in the company's entire history, it was operationally profitable. Not because the business changed, but because the ambition finally matched reality. And here's the part that matters most, for understanding what WeWork actually is in 2025. Under Yardi's ownership, the technology layer that was always promised is finally starting to be built. WeWork reinvested over $80 million in capital improvements in 2025 alone, including real upgrades to building systems, connectivity infrastructure, and workspace automation technology. The WeWork app, which previously just let you book a room, is evolving into something more substantive. A workspace management platform called WeWork Workplace now integrates space utilization data, real-time booking across the global portfolio, and analytics tools that help enterprise clients understand how their employees actually use space. They've also launched what they call the Co-working Partner Network, a model where WeWork's platform extends beyond its own buildings into partner locations across suburban markets. In other words, WeWork is finally becoming a marketplace. Slowly, cautiously, without the hype, but the direction is right. Yardi's stated goal is to be, and this is their exact language, the technology backbone of the entire flexible workspace industry. Not just WeWork's technology, the industry's technology. And the most remarkable thing about that vision, it's almost exactly what Adam Neumann claimed to be building 15 years ago. The difference is that Yardi is actually building it, and they're doing it the boring way. Quietly, profitably, without the parties, the private jets, or the philosophy about elevating the world's consciousness. Sometimes the most important difference between success and failure is not the vision. It's the willingness to do the unglamorous work required to execute it. Narrative is not a business model. People focus a lot on Adam Neumann when they tell this story. And yes, the personality, the spending, the governance failures, those were real. But they're not the lesson. The lesson is this. In the age of SoftBank and Vision Fund and zero-interest capital, the story you told about your company could be worth more than the company itself, temporarily. WeWork is proof that narrative can create valuation, but it cannot sustain it. Eventually, through an IPO, through a recession, through scrutiny, the system gets exposed. And if the system underneath the story is not what the story claimed it to be, everything collapses at once. Growth is not the advantage. Systems are. In the modern economy, the companies that win long-term are not the ones that grow the fastest. They're the ones that build systems that get stronger as they grow. Amazon gets more data with every purchase. Google gets smarter with every search. Spotify gets better at recommendations with every listen. The more they scale, the more powerful the system becomes. WeWork got more expensive with every new location, more complex, more fragile. That's the difference. That's the test you should apply to every business you evaluate. Does this company get stronger as it scales? Or does it just get bigger? The danger of the wrong vocabulary. There's one more lesson here, and it's subtle. Language matters in business. The words you use to describe your company shape how investors, customers, and employees see you. WeWork called itself a technology company. It used words like platform, community, ecosystem, flywheel. And those words worked, for a while, because the people evaluating WeWork didn't always stop to ask, okay, but what is the actual technology? What is the actual platform? Show me the system. The moment those questions were asked in a public filing, the spell broke. So the next time you hear a company describe itself with the vocabulary of Silicon Valley, ask the follow-up question. Always ask the follow-up question. WeWork didn't fail because it grew too fast. It failed because what was underneath the growth was never designed to support it. The vision was real. The demand was real. The problem they solved was real. But the system was a story. And in the end, no matter how good the story is, stories don't pay 15-year leases. WeWork sold the future of work. They just never built it. And the deepest irony of this entire story, the future they described, is now being built by a quiet software company from Santa Barbara that no one had ever heard of. And they're doing it without a single word about elevating the world's consciousness.